TJ, the wheel deal coming at you live. It is Thursday, Friday Junior, baby. Friday Junior. So we're going to get into it. I'm just trying to find us live here. Friday Junior. There we go. So I'm watching it on YouTube over here so that I can make sure that I'm showing y'all the right stuff. So I can make sure I'm showing y'all the right stuff. Anyway, I'm TJ the Wheel Deal. I sell puts. I sell calls for a living. Rowan makes dollars and cents. I'm known to buy the timely leap. I had some M&Ms for breakfast. I'm eating those right now. That's what I'm chewing. Breakfast of champions right there, baby. Breakfast of champions. But anyway, rewarding myself. I ran 9 miles an hour on the treadmill. Today, I'm going to go for 9 miles again, but I'm going to try to do it like 4 different times, like 15 seconds at a time. I'm trying to build up doing more higher intensity stuff versus just like walking at an incline for like an hour. And it's cool, but it takes forever to burn calories. And I just want to get the body moving, faster, because I feel like I've been doing everything slow for a few years now. So anyway, it's fun. It's fun. So my reward was I've had these M&Ms for about 4 months. I don't even know they're good anymore. They've been in the fridge. So there's like 10 of them in there, and I'm going to eat them all today, and I don't even care. I don't even feel guilty about it. Guys, today is going to be a good session for you guys and for me because this is going to appeal to the what if crowd. And what if Palantir goes out to 200 tomorrow? What are you going to do? What if Palantir goes down to 100 tomorrow? What are you going to do? What if MSTR goes to 5,000? What are you going to do? What if Palantir goes? What if MSTR drops to 50? What are you going to do? It's the what ifs. It's the what ifs. Well, I grew up in a day and age where if my aunt had a penis, she'd be my uncle. That's not true anymore. We don't know. What does she identify as, right? What does he identify as? We're in a different day and age, guys. I'm a what is guy. Talk to me about what is. That is the reality. That's the world that I like to live in. But when you're dealing with portfolio margin, you do have to be cognizant of what is. Because what is can one day become the reality. So it's very, very important to know what would really stress out your account and what could potentially blow up your account. So I've been on the Stage Trade platform for over a year now. I still don't understand all the gimmies and gotchas. So we're going to learn a little bit together today. So we're going to go over some stuff on Google AI over here, and it's going to tell us about some of these metrics. And then I'm going to show y'all where I play when the market's not open. There's this cap requirement button that you click. It gives you the asset allocation, and then it gives you the risk analysis, and it runs a stress test on your portfolio where the underlying moves plus or minus 15%, the IB goes up 10%, and then you see what does that do to my account? What are all the gimmies? What are the gotchas? How much money could I lose? How much money could I make? And what's my sweet spot? So we're going to go over that, and I'm going to make sure that you guys understand it. And I'm going to ask y'all several times, are you getting it? Are you getting it? Are you getting it? So the more interactive that you are today, the more you're going to learn. Earmark this one. Share it with a friend. And I'm going to do this one over and over and over again. I'm going to do this type of live over and over and over again for people that really want to understand why I don't worry that much about what is, because I've already looked at it and I've already got a plan in place on what would I do if shit hit the fan. It's really, really important that you have that plan in place that if shit starts hitting the fan, what are you going to do? What are you going to do? Or are you just going to freak out? Your blood pressure is going to get all elevated. And you're just going to start pushing a bunch of buttons and hope that it all works out. You're probably going to blow up your account, especially whenever you're playing supersized the way that I play. So you have to be really, really familiar with these numbers. So anyway, let's get into it. First things first, 1 minute with God. So let me knock that out. I think we're the 26. Yeah, 26. So 1 minute with God. So let me find it over here. Ooh, this is a long one today. Okay, let's do this thing. 1 minute with God, March the 26th. Remembrance. How can remembering God help me in my spiritual walk? Moses reminded the people to take every opportunity of every day to remember God's word and to tell family and friends of God's past help and blessings. If you do this each day, you will strengthen your love and commitment to God, and this will motivate you to be even more faithful in following days. God helps you to fight and to win life's battles. Remember God the first thing in the morning and as you fall asleep at night. Remember God is the source of the hope you think you've lost. Remember God with a thankful heart when you have plenty, for you will need him when you have little. Weave him into the fabric of your life, and your spiritual walk will be strong and focused. God's response. You must commit yourself wholeheartedly to these commands I am giving you today. Repeat them again and again to your children. Talk about them when you are at home and when you are away on a journey, when you are lying down and when you are getting up again. Tie them to your hands as a reminder and wear them on your forehead. Write them on the doorposts of your house and on your gates. Deuteronomy 6, 6 and 9. God's promise. If you keep looking steadily into God's perfect law, the law that sets you free, and if you do what it says and don't forget what you heard, then God will bless you for doing it. James 1 and 25. That's March 26th, 1 minute with God for men. Peace out. So there's that. A lot of good stuff there, man. A lot of good stuff there. So let me go over here and find my glasses and import this. And if I remember here after a while, I will post it on X and we'll get into it. Let me check in with a couple of y'all this morning. What's going on, Manish? What's going on, Nathan? Hey, TJ, mind showing how much is your capital versus the leverage, like 1 to 5? We're going to get into it today. This isn't a what if. This is a what is. We're going to get into the weeds today. But you also have to understand that we're all running our own race. We're all on our own journey. So whenever you see our portfolios, you cannot see how much money we have on the sidelines, just like I can't see what you guys have on the sidelines if you have anything. So if we didn't have extra monies on the sidelines, I'm playing way, way, way too big. So that's why I'm reluctant to do these types of things, because y'all just look at an expiration date and be like, oh my God, what's going to happen? Y'all are those people, most of you. You don't know when I plan on rolling. You don't know if I'm going to take assignment. You don't know ultimately what I'm trying to do, because I'm the one flying this plane, just like you need to be flying your plane. And I appreciate the people chiming in. I appreciate the people taking an interest in what I got going on, but I always post on X. I got me. Make sure that you got you. You follow me? Because I'm the one that's going to blow up the account if that were to happen. Highly doubt that it would, but you never know, right? You're the one that's going to blow up your account. So you need to make sure that you are on track of these metrics for you, if that makes sense. I have a pretty good idea of what I'm doing. I'm pretty good at selling puts and calls. Ask around. You know what I mean? I'm pretty good at selling puts and calls, but I'm new to portfolio margin. Only been using that for a little over a year. So there was a lot of metrics that I had to learn so that I could understand the gimmies and the gotchas. And we're going to talk about the things that I learned today. And then we can revisit this conversation in 3 months, 6 months, a year, because I feel like I'm going to have an even better understanding of these metrics moving forward. But keep in mind, everything in the account is supersized right now. But you also have to consider the amount of money that we have on the sidelines that we can inject into the account. Keep that in mind. There's a lot of people that you don't know. If you don't know me, you don't know me, right? You don't know us, you don't know us. I get it. I get it. So you're just going to look at something and you're just going to draw a conclusion. People come at me all the time in the comments, and I'm like, dude, spend more time analyzing your portfolio. You'll be better off. Anyway, let's get going. I have a goal to learn options this year and advice to get started in terms of mindset and what to focus on. I would say watch a bunch of videos, man. Watch a bunch of videos. I put out a seminar. There's a couple of people that put out option seminars. Watch Tasty Trade, man. I've watched hundreds of hours of Tasty Trade. They go over a lot of this stuff. They got the Mike and his whiteboard, Dr. Jim, the Batistas, Tom. There's some ladies there that I listen to as well. There's just so much good information on Tasty Trade. So I would just go through their library and make it make sense. Like, go through their library until it makes sense, especially like if Dr. Jim's talking or Mike and his whiteboard are talking. The Batistas, they just have a way of explaining things to where it makes sense. Whereas I feel like I stumble. I'm not as good an educator as they are. What's going on, my man? Josh, happy to be here. Morning, TJ's perfect timing. I was researching about margin for the last hour, and boom, you go live. There we go. There we go. So let's get into it. So I think the first thing that we might want to know is what the heck's portfolio margin. Now, keep in mind, I deal with larger accounts. So there's typically two margins out there. So I think it would help me if I was actually presenting, first of all, though, because this isn't going to show up if I don't present. So we're going to go entire screen. Boom. So we'll do that. We'll do that right there. And let's talk about the AI overview right here. So I'm just making sure that it populates. Okay, we're good. So I'm going to try to make this a little bit bigger. There we go. Portfolio margin at Tasty Trade is an advanced risk-based margin methodology for high net worth accounts. 125,000 initial deposits. I always say it's 175,000. Call it 200,000 just to be safe. That calculates capital requirements based on the entire portfolio's risks rather than individual positions. It offers up to 6.7 to 1 leverage, significantly lowering buying power reduction for hedged or diversified positions. Key details about portfolio margin. You must have the works account level with a minimum of 125,000 in equity to apply and $100,000 to maintain. I think that this is more like 175,000 personally. How it works. Positions are stress tested using simulated price moves, typically plus or minus 15% to 20%, and volatility changes to determine the maximum potential loss, which dictates the margin needed. Benefits. Lower capital requirements on options positions, allowing for higher leverage. Risks. Increased leverage can lead to rapid accelerated losses. Guys, this one's very basic. The more money that you can make is usually proportionate to the amount of money that you can lose. The higher the risk, the higher the reward, as is life. As is life. That's a microcosm of life. That's not just in the investing world. That's a microcosm for life. Limitations. PM, portfolio margin, does not apply to futures or cryptocurrency, only to equities and options. Downgrade. If the end of day net liquidation value drops below 100,000, the account may be downgraded to standard regulation T margin. So I do not recommend turning on portfolio margin unless you have at least $250,000 in your portfolio, your net lick. And in my personal opinion, you probably need to have been selling options for at least a solid 3 years. I I would highly recommend it. It's not financial advice. Do your own thing, dude. Do you, boo? You know what I mean? I'm just trying to do you a solid here. I'm going on year 6 of selling options, and I felt like I was finally ready about a year ago. And here we are. But I've learned a lot more in the last year about risk analysis and risk management than I did the first 5 when everything was cash secured and you owned the shares to be able to sell the calls. You don't have to be as mindful. Like I was like, oh, I'm selling puts on margin. In other words, the amount of collateral that I was utilizing exceeded the amount of cash in the account. That was about the extent of it. Occasionally, I've owned some shares on margin, but seldom did I even do those things. So now I'm like, you're talking about swimming naked. What? It was a whole new world. It was a whole new world. So anyway, so there's that. So then now we can get over here and be like key metrics to know when dealing with portfolio margin. Another AI overview. Key metrics for Tasty Trade portfolio margin include expected price range, point of no return. That one is serious business. Serious business. What's the point of no return, guys? That is where your net lig goes negative. No bueno. No bueno. Buying power reduction, PPR, and net liquidating value. PM requires a minimum of 175,000 to start. You see, this is saying what I believe because I think that Tasty Trade has changed these regulations or these requirements over the years. I think this is the latest: 175,000 to start and 150,000 to maintain, utilizing live stress tests. Key negative 20% plus 15% for lower capital requirements on hedge positions. Core portfolio margin metrics, Tasty Trade. Why am I focused on Tasty Trade? Because I trade on Tasty Trade. Do this and plug in your brokerage so that it's more applicable to you. EPR, expected price range, estimates a security's potential one-day move based on volatility used to define the stress range. Point of no return, PNR, the portfolio price level where your account balance becomes negative. Debit, ideally, this should stay outside of your expected price range. If this point of no return is right in there with the expected price range, you're at a very, very high risk of blowing up your account. Keep that in mind because we're going to look at these metrics whenever we get into the portfolio. I'm going to pull back the curtain today so that we can stop playing the freaking what if game. Why don't we talk about what is? Fair enough? Give me a thumbs up if you believe that what is more important than what if. I see a comment here. Why did I exit PayPal? Buying power issue. I totally intend on getting back into PayPal, but there was money that I needed to make right now. What money on what account? On Amazon and MSTR. The money that I had to lose on paper on PayPal was going to be offset by money that I can make on a shorter term basis on Amazon and MSTR, and there's only so much money to go around. There's only so much buying power to go around. So I was supersized. I got caught my hand in the cookie jar. So I was like, I'm going to go take my medicine on PayPal. I'm going to go make money on Amazon and MSTR, and then I'll revisit PayPal. So that's how that happened in a nutshell. Buying power reduction. The capital locked up for a position. PM uses risk-based scenarios to calculate BPR, often resulting in lower requirements and regulation T for diversified portfolios. Net liquidating value. I always say net liquidation value. Your account value, the cash plus stock value plus options value must stay above $150,000. Margin concentration. If a PNR, the point of no return, falls within the expected price range. Due to large concentrated positions, Tasty Trade may increase your margin requirements. Key requirements: minimum equity, 175,000 to apply, 150,000 to maintain. Margin level: monitor for a healthy buffer, e.g., greater than 300%, especially when using high leverage. Notes this Instagram post. Stress test. Requirements: often consider at least plus or minus 15 to 20% move depending on volatility, says Tasty Trade. Dive deeper in AI mode. Here's some videos here, guys. I was actually on this live. I was listening to these gentlemen right here. Dive into capital requirements and portfolio risk analysis. It's a real good video, hour long. Highly recommend it. Introduction to Tasty Trades Risk Analysis Tool webinar. Watched it. Amazing. Those y'all have shorter attention spans, this one gives you a real good feel too. 9-minute video. Watched it again this morning before going live. My trading was inefficient until this study. It's the goats, right? Tom and Tony talking about it. They're going to do a hell of a better job than I could ever, because they just have a lot more experience. Again, how do you qualify for portfolio margin, right? With Tasty Trade? Requires a minimum of 125 to 175 in equity, depending on and you just go and you're gonna have to take a test. It's like 10, 15 questions. You're gonna have to show that, hey, you got an idea of an understanding of what's going on, how it works. How to calculate portfolio margin. Portfolio margin is determined by a stress test where the theoretical profit or loss, P&L cubed, is calculated if and when the price of a stock or index drops or rises, and volatility drops and rises by percentages determined by PM rules. Understanding portfolio margin by Charles Schwab. What is the 50% margin rule? You got to go through this stuff, man. You got to go through this stuff so you can become very, very familiar with it. So just do this on your own time. We're going to spend a lot of time over here, but this is real important. What is margin trading and how does it work? Why do 90% of options traders lose money? AI overview. About 90% of options traders lose money due to a combination of high risk, lack of education, emotional decision making, and inadequate risk management. Key factors include fighting high volatility, losing capital to rapid time decay, and trading with a gambler's mindset rather than a statistical edge. Here are the primary reasons why most options traders fail: lack of knowledge and education. This one's tough because there's a lot of people that feel like they know it all already. I've been doing this for 6 years at a pretty damn high level, and I could tell you that I am like not even 50% there on my journey as far as knowledge that I would like to have. I'm not even 50% in, going six years in. I'm not 50% there in my mind of where I feel like I will be. And I have placed thousands of trades, thousands and thousands and thousands of contracts. Maybe you're just a lot smarter than me and you know everything. I'm smart enough to know that I'm not the smartest person in the room. Many traders do not understand complex concepts like implied volatility, theta decay, or proper strike selection. They may buy options thinking they are simply cheap without understanding the low probability of success. Time decay, theta. Options are wasting assets. If the underlying stock does not move significantly in the right direction within a specific time frame, the option's value drops, often resulting in a total loss of premium. Emotional trading. Fear and greed cause traders to overtrade, exit winning positions too early, or hold losing positions too long. Poor risk management. This one's key. This one's key. This is one where I have been learning for the last year to make sure how big I could actually trade and be okay. So I've already learned some very expensive lessons along the way, and I'm trying to share these with you guys so that you guys don't go down the same path. I'm over here, I already went over there, came back. I'm telling you what's over there. It's going to be up to you whether or not you want to go down a different path. I'm telling you, size matters. It's really, really important, guys. Many traders fail to use stop losses or allocate too much capital to a single high risk trade. I am the poster child for that. That being said, I've also made a lot of money on oversized trades. But if you can make a lot of money, it stands to reason that you can lose a lot of money. Underestimating volatility. Again, these are all bumps and bruises that I have over the last year, and I'm trying to help you to not have those same bumps and bruises because I like you and I'm trying to do you a solid. Trying to do you a solid here. Buying options when implied volatility is high or expensive means that if volatility drops, the options price falls even if the stock price stays the same. High transaction costs, frequent trading, over trading accumulates commissions that eat into your profits. Have you guys noticed over the last couple of years, over the last couple of weeks, that I'm trading less and less and less? Because I'm like, let me just stick in these positions, let me try to make as much money as I can. And I'm not going to over manage or over trade the positions because even if I'm right, if I over manage, I mean, all of those commissions, especially with the amount of contracts that we deal with, Tasty Trade's just going to love us, but we're ultimately not going to be making as much money because I'm over trading and I'm over managing. To combat this, successful traders generally focus on strategy, education, and managing risk rather than chasing high leverage, low probability wins. What creates 90% of millionaires, et cetera, et cetera, et cetera. This is all the stuff that you guys can go down. Fair enough? Let's get into it. Let's get into it. Let me check in with you guys, and then we're going to pull up the account, and we are going to understand what is. We're going to look at the metric where I live. We're going to look at the metric where I live when the market's not open, and that's the risk analysis tab. So we're going to get into it. Before I do that, I want to check in with some of you guys because I appreciate you guys staying here with me. I just love how you manage risk so calmly. It's just, I'm just executing the game plan, man. I'm just executing the game plan. I talked about that one, manufacture the win. Where's the lead by TJ? Did your ability to calculate intrinsic value of a stock impact or option selling journey? Still working on that one, but yes, like you got to know what you own and why you owned it and what is an ideal price that you are willing to pay for it, because the price is the price, right? Mr. Market sets that price. But you have to study the M's, man, the moat, the management, the money, the market sentiment, the methodology. You're going to have to decide whether or not that stock can make dollars and cents for you. Appreciate you guys. Appreciate you guys. Appreciate you guys. I'm on a flight from Vienna to JFK. My SoFi is bleeding. It's bleeding for all of us. It's bleeding for all of us. I have 25,000 shares of SoFi and 120 leaps expiring 12/27. I'm not ready to cover calls. One of these 30 per share. There's no premium. Should I go a year out? Ouch. I'm pretty much in the same boat, but I'm selling calls, man. Like, gotta sell calls. I think you're okay. At SoFi 19 average, you're gonna be fine, in my opinion. So wants to go to 10 and hood to 50. We'll see. We'll see. Out of all these, sizing has been my main issue. Yeah, I would say that not even so much sizing for me. It's having too much size on when the IV wasn't high enough or the IVR wasn't high enough. You can have a lot of size on when you're also playing for volatility contraction. So I would say that's like my biggest takeaway so far. What's your tax status? Do you qualify as mark to market or you have tax trader status? Yes. Just got all that going this year. TJ, what's the Martian ratio you're currently using? We're going to get into all of it, man. We're about to get in to all of it. So y'all can make all of those calculations and determinations yourself. Soxel, Be careful at these levels. Be careful, man. Like Soxo was the trade of the decade when it was like at 15. When it was like at 15. Anyway, guys, I got to get into it because if I just do this all day, we're not going to get anywhere. Fair enough? Let's get into it. Let's get into it. So here we go. So here's the portfolios. Bleeding out a little bit today. Nothing too crazy. Nothing too crazy. We're going to stay right here. We're going to stay in account ending in 60 right here today so that you guys can understand what it is that I look at. And when we go into the cap requirements over here and we go into the risk analysis and the asset allocation and all of that stuff, you should already have an idea whenever you open up these positions right here. When you open up these positions, and in fact, what I'm going to do just to make sure that we got 100% focus here is I'm going to eliminate all of these from the background. So all we have is the one account. That's it. That's all that we got here, right? That we can. So I want your focus to be right here because I can look at this right here and I should be able to deduce in my mind if the stock goes this way, how much do I feel like I'm making? If the stock goes this way, how much do I feel like I'm losing? Or if the stock goes this way, am I making money or losing money? In other words, am I ultimately short delta or am I ultimately long delta? These are all things from a macro perspective, looking at your account from a macro point of view, from the Eagles' point of view. You should be able to know just by looking at it. And then when you go over to the cap requirement and run the risk analysis, it should confirm what you already know. But now you're going to have specifics. You're not going to have to be like, oh my God, well, how much am I losing in Palantir? It goes up or down 50%. This thing's going to tell you. This thing is going to tell you. It is awesome. And I'm going to show you what I'm talking about real quickly before we get there. Right here, you're going to go cap requirements. It's going to tell you how much capital you're utilizing in each account, and then boom, risk analysis, right? So you go here, you click all of them, you run the risk analysis, and it's real busy. So you look at it, you're like, oh shit, I see a lot of red, I see a lot of green. Relax. By the time we get done with this, you're going to be able to use your portfolio, plug it all in, and you'll be like, it's not actually that intimidating. It's not actually that intimidating. Let's get into it. Let's get into it. If you feel just because you've already seen the screen that we're ultimately going to look at, but I'm gonna focus on one position at a time when we get over there. So it's not going to be so busy. It's not going to freak you out. But if it looks a little bit intimidating, it was intimidating for me too. We're going to get you there. We're going to get you there. And I'll do this 3 or 4 or 5 times until we get it as a team. Fair enough? Type in fair enough on the comments. Let's do this thing. So BM&R, what do we got going on with BM&R? We have the leaps. So we already know in our mind that if BM&R goes up, these leaps should print money. So when we get to the risk analysis tab, it should confirm that for us, right? It should be like, hey, these leaps are going to print a lot if this thing goes up 50%, 100%, 15%, whatever the metric ends up being over there on the leaps. But if it goes up, it stands to reason that these short calls are going to be losing us money. It stands to reason that if BM&R goes down the way that it is today, that these leaps should be losing money, and they are losing money today. And it stands to reason that these short calls will be making money because we're getting farther away from our strike price. And I'm thankful yesterday or the day before that I locked in a nice little $85,000 win on the short calls by rolling down from 30 to 26. BM&R was showing weakness. Ethereum was showing weakness. I'm like, okay, well, let me bring in more money because I had already gotten paid $87,000 for selling the 30s. I was like, you're going to give me more money from rolling from 30 to 26, and we're still broken even a little bit better than break even on the leaps that we purchased 24 days from ago. I like it. Amazon, we have 25,000 shares. So right away, your brain should say, if the stock shoots up, those 25,000 shares are going to print. That logic makes dollars and cents. And you would be right. But if you look at the position, you have 250 short calls. So these shares, these 25,000 shares are for sale at 230 and they expire in 22 days. So we know that if Amazon goes up, even though the shares are printing, we're going to be losing money on the short calls. We know that. Like if it spikes above 230, we know that we're leaving a lot of money on the table. So it stands to reason that on the risk analysis, it's going to probably show us losing money if Amazon shoots up, because we have 1,250 short calls at 240 as well. So if Amazon spikes up, we're going to be getting our ass kicked on the 230 and 240 short calls, even though we're making some money on the 25,000 shares. But what's also going to help us to make money if Amazon goes up is the $180 puts are going to be printing, because if Amazon's going further away from our strike price, those puts are going to make money. So it's like we got 2 versus 2, a 2v2. Amazon shoots up, what's making us money? The $25,000 shares and the $180 puts. What's losing us money? The $200, the $230 short calls and the $240 short calls. So we already know that. Now let's talk about what happens if Amazon goes down. What's losing us money? What's making us money? If Amazon goes down, what's going to lose money? The shares. $25,000 every time Amazon drops $1. That is just very basic math. If you can't wrap your mind around that kind of logic, I can't fucking help you. If you don't understand that if you own 25,000 shares and if Amazon goes up, that's a good thing. If Amazon goes down, that's not a good thing. I don't know what you're doing here today. I don't know what you're doing here today. You're not even at the back of the class. You're not even in the auditorium right now. So just let me know whether or not that part makes sense for you. If not, please kindly go watch something else, because we're wasting each other's time at that point. If Amazon goes down, we're getting our ass kicked on the shares. If Amazon goes down, what else is going to kick our ass? The $180 puts. And now you start looking at, okay, well, how much extrinsic value is tied to that position? There's 1.185 million. So it's big whenever you consider the extrinsic value on the short calls. So what's going to make us money if Amazon goes down? The 230 short calls are going to make us money, but they can only make us so much because there's 387,000 in extrinsic on the 240 calls, and there's only 25,250 of extrinsic on the 230 calls. I might have misspoke. This one's 240, this one's 230. So if Amazon goes up, what makes his money? The shares and the short puts. What loses money? The short calls lose money if Amazon goes up. And it's the inverse if Amazon goes down. What loses money? The shares and the short puts. What makes money? The short calls make money. That's your macro outlook. Now you ask yourself, well, how much money? And that's where you can just go to the tabs. We're going to stay on Amazon right there. We're going to make it make sense for you guys. So you hit your cap requirement over here. We go over here to the cap requirement, and then we're just like, okay, let's get rid of all the noise, and let's just put Amazon up there. So now I know it still looks a little bit busy. You see a lot of red. You see a lot of green. It's color coded for you, man. Green's good. Red's no bueno. So now let me walk y'all through it. So we already said that it stands to reason that if Amazon goes up, we make money on what? The short puts and the shares. We lose money on the short calls. So we're going to stay over here. So Amazon's right in this range, right? The 210 range. So it's right here in the middle where y'all see the cursor. Hopefully you guys can see the cursor. So now let's see, okay, what's our sweet spot? In other words, how much can Amazon go up so that we're making more money on the calls and on the short puts versus the money that we're losing on the short calls? I'm sorry, they're making more money on the shares. The shares are making us money, $25,000 for every dollar that it goes up. And we should be making money on the short puts because we're getting farther away from our strike price at 180. So we want that money to be bigger than the money that we're losing on the short calls of the 230s and the 240s. So let's look at it. So the way that these parameters are set up is plus or minus 15%. So it's giving you, like, if Amazon goes up 15%, that's going to put the share price at $243.41. If Amazon goes down 15%, it's going to put Amazon at $179.92. So this is the whole what if game. Oh, what if this happens? Well, let's go. What if? Let's turn that into what is. You don't have to guess. Tasty Trade is going to give you all of these metrics, man. It's awesome. Tasty Trade is going to give you all of these metrics. So if Amazon goes up 3% to 210, we're making money, $293,000. What's the breakdown? So now we're going to go find our shares. We're going to start with our shares. So the shares would be making us a cool $158,000. Now we're going to go find the short calls. I said that if Amazon goes up, the short calls are going to be losing us money. How much? $33,000 on the 230s and $209,000 on the 240s. Because it's putting pressure on our short calls. The good news is those are still both out of the money. But what's going to be making us money? The short puts. So this thing is following what we already knew. We already knew that if Amazon went up, we're making money on the shares and we're making money on the short puts. We're losing money on the short calls. And this is just giving you how much now. So it goes up 3% to 218. We're making 158,000 on the shares. We're losing 33,000 on the short calls at 230. We're losing an additional $209,000 on the short calls at 240, but we're making 141,651 on the $180 puts that expire in December of 2026 for a collective of 293,000. Now, if it goes up to 224,000, it's even better, or $224 a share. We're making a total of 327,000. But you can see how it becomes a point of diminishing returns if Amazon goes up like crazy, because the money that we're making on the shares, if it goes to 230, the money that we're making on the shares, the money that we're making on the short puts is being offset by the money that we're losing on the short calls at 230 and the money that we're losing on the short calls at 240. And then if it really goes crazy, it actually hurts us if Amazon goes up, because our hedge stops working to the upside. Because what's our hedge? The short puts is our hedge to the upside, and owning the 25,000 shares is our hedge to the upside to mitigate against the short calls, the naked calls. So if it goes up like crazy today, if it goes up 12%, we'd actually end up losing money on the position. The money that we made on the shares, the money that we made on the short puts is going to be offset by the amount of money that we're losing hand over fist on the short calls at 40 and the covered calls at 230. And then it spirals even more out of control if Amazon were to pump up to $243 today. We could lose $1 million on the upside. But now let's take a look at the downside. We lose a lot more money. Why would we lose a lot more money? It's real simple, because we own 25,000 shares. Every dollar that it goes down, we're getting our ass kicked $25,000. And when we looked at the extrinsic value, there was a lot more extrinsic value tied to the short puts than there are to the short calls. It was over $1 million on the short puts versus a few $100,000 on the short calls. So the money that we would be losing to the downside would spiral out of control. That's why this is a very bullish bet overall on Amazon, but it's not a super bullish bet. So what's our sweet spot? We need Amazon to cap out between 210 and 220, 225. That's what we need to maximize the money that we're making on the shares, to not get punished so much on the short calls and the cover calls, and to make money on the short puts in the distance. So that's how you look at it. Give me a thumbs up or say it's starting to make sense. Type in the comments, it's starting to make sense. Because guys, here's the thing. I'm doing this for you. I already understand it. I want to make sure that you guys understand it, because I do a lot of FaceTimes with a lot of you guys, and y'all are like deer in a headlight. Like, you have no idea what's causing you buying power, what's going to give you buying power. Like, you should be able to look at your portfolio and you're like, if I make that move, that's going to cost me buying power. If I make this move, it's going to give me buying power. Like, you should be able to look at the positions that you have on and know that already. So now you go to this table here, to this table right here, and then it's going to tell you, okay, this is how much money you would be making. This is how much money you would be losing. And then now you can also change the dates over here. You're like, okay, when's my expiration? 4/17? Well, what if I did this at like 4/10? What would that look like? And it's going to change the numbers somewhat. Why? Because it's going to take into account all of the data decay that has occurred. And they're like, well, what if the volatility really spikes out of control? We'll put it at 20%. See what it does. And you're gonna see whether or not there's an effect on the volatility. So you should start playing with these parameters, and you start changing the expiration date over here. And then it's going, evaluate, right? Evaluate on this day. What would it look like, all things being equal? Because, we're pretending that we fast forwarded the clock. It's going to crunch all of those numbers for you. It's going to crunch all of those numbers for you and tell you where you would stand. So you notice that if I push the clock over to the right, and if Amazon shoots up, we lose less money. Why is that? Versus over here. Versus over here. Why is that? Why is that? It's because time would have already gone off the clock. So make no mistake about it, we're collecting and capturing data on a daily basis. So that's how that checks out in a nutshell. Now let's go another one. So we're going to look at it. So I look here and I'm like, okay, cool. What's costing me money? So right now we're at 56% buying power usage. Not bad. Not bad. Y'all wanted those metrics? They're right there. So which one's using the most? Palantir. Palantir's using the most. And then we got Amazon's using the most. And then we got BM&R. Then we got MSTR. And then SoFi over here on the bottom. So then now you look at it's the initial requirement, the maintenance, the alternate minimum, FINRA, the alt minimum Vega, alt minimum extrinsic, EPR, expected price range down, expected price range up. And then now we're going to go point of no return. So let's look at these right here. Let's study these right here. So we got 30, 60, 60, 35, 50. Remember those numbers. Your point of no return should not be in those areas. If not, you're supersized and you run danger. You run danger. So let's look at this. 30%, 30, 60, 60, 35, 50. Look at our point of return. Negative 63%. So we lose a shitload of money if Amazon tanks 63%. The BM&R going up 101%. It's kind of irrelevant because I would roll the call, so I don't even look at that one. 65% on MSTR. It goes up. It's no fucking bueno. No bueno. Palantir goes down 63%. No bueno. SoFi would have to go up 101% for it to be no bueno. So we're going to look at these numbers, and then we're going to look at these numbers right here. And I saw a 60 there on MSTR. And it's 65. So can you see how that one is carrying quite a bit of risk? And how many times have y'all heard me on the channel say the risk is to the upside on MSTR? It scares me a lot more than the downside. So now I look at it and I'm like, okay, well, let's look at it. What do we got going on here? How can I eliminate some of that risk to the upside? I could potentially take that trade-off right there. I'm like, okay, well, let's analyze it. Been in the trade for 2 days, already up a cool $21,000. Is it worth having all of that risk to the upside for an additional 61 bucks, $61,000? Because if MSTR tanks, we already know we're going to do the risk analysis on MSTR here in a second. We already know that this one's going to get slaughtered, right? It's already getting slaughtered because MSTR is tanking today, and it's being offset by the money that we're making on the short calls. Let me stay on Amazon for a second just to make sure that it was clear. Amazon goes up, we're making money on the shares. We should be making money on the puts, right? We're not making money on the puts yet. That's interesting. So why wouldn't you be making money on the puts if Amazon goes up? Because the IV might have spiked or something like that. That could really be the only reason. But if it's gone up, it stands to reason that we're probably losing a little bit of money on the short calls. So all in all, being down 24% on Amazon, being up or down 16%, that's just volatility stuff because Amazon hasn't really moved one way or the other. So ultimately, we're just looking to try to collect some data. 1 o'clock, 2 o'clock, that data is going to go on our side of the ledger, and that's going to help. If Amazon stays right here and the volatility doesn't spike too crazy, by the end of the day, this position could get a lot closer to positive without any positive price movement. Obviously, now Amazon's pumping a little bit, so that's good news. So at some point, if it keeps pumping, this negative on the put should turn into a positive. And then the good news is that we keep making more money on the short calls. So that is what's going on with Amazon. Now let's focus on MSTR because this is a really, really big strangle. Really, really big strangle. This is an agreement to deliver $18 million worth of MSTR in 22 days. If MSTR were to pump to $180, what would make it pump to $180? Bitcoin would probably have to go to like 85 grand or so, maybe 80, 85 grand, something like that. It's not very likely. It could happen. It's not very likely, I feel. And what would I do to make sure that we don't get into that point of no return? We already know that I would roll. We already know that I would roll, or I would just cut the loss. I mean, especially here, it's easy because I could close this. I'd close this out right now. It hurts my buying power because we become more directional. In order to make money, we need MSTR to go down, to go up. We lose a lot of money if MSTR goes down. Why? Because the short puts have a much higher delta than the short calls. Let me clear that. So I'm not going to take that off just yet. I'm going to try to milk it to like 40% or so, 40 or 50%. These short puts have $1 million of extrinsic value tied to them, and it's a 20 delta. The same amount of contracts on the call side only have a $304,000 extrinsic value tied to them. Why? Because we could capture $278,000 right now if we closed it out. So effectively, if we gave back $365,000, we could eliminate all of the risk to the upside. Keep that in mind. The reason I don't want to do that is because if MSTR tanks, we're going to lose a lot more than $365,000 to the downside. So I want to get rewarded if MSTR were to tank. So I'm still comfortable playing it within the range because it has to dip about 15% or so to get to 110. So we're like right there. So we're going to go look at the cap requirement. We're going to do the risk analysis and all that stuff on MSTR and see, well, how much do we make if it goes up or down, and how much do we lose if it goes up or down, vice versa. So I'm telling y'all right now that this thing would do better. Just eyeballing it, you have to be able to come to these conclusions, and you're going to go to the other page to verify. Just eyeballing it, I'm telling you it's going to do better if MSTR goes to like 150, 155 and camps out right between the strikes. That's going to do better. In the short term, if it spikes quickly, since this one's expiring here in 22 days, that one to get clobbered. That positive will turn into negative really, really quickly because there's more time on the clock. This one's not going to get as hammered as much. It's a 10 delta. It'll get hammered, but not as much. It's going to get offset by the money that we're making on the short puts. So I'm telling you that just looking at these positions, in my mind, it makes dollars and cents that if MSTR goes up like $5 to $10, we should be printing money. We should be printing money. If MSTR goes down another $10, the money that we're making on the short calls, it's going to feel like nothing compared to the money that we're losing on the short puts. So I know that if it goes down to like 120, I'm done. I got to roll this thing. I'm going to have to roll this thing, and I have to go to another cycle. I'll probably go somewhere like in July, and I'll be like, okay, let's take some risk off the table. Give me another $500,000. I'll try again later. I thought that 110 was going to be good. I was already at 100. I got greedy. I went to 110, and now I'm having to roll back down to 100. But the cool news is the algorithm's going to like it. It's going to increase my buying power because we're taking pressure off the portfolio. And they're going to reward us with another $496,000, and we can go wait it out. So I already know the move that I can make, but I want to realize some wins. So notice how I didn't talk about rolling these calls out. If it goes south, I'm like, if it's going south, there's no reason to roll these calls out. Let me milk that money, and let me just take the harm out of the equation if it were to tank, and let me just roll this one out. If I want to roll it out and be even more conservative, I roll it out in August, and I'm like, well, now let me roll it. Let me roll it to 90. I don't quite pick up the $500,000. I pick up 425. It still increases my buying power, but talk about reducing a lot of the risk from the portfolio, because now the obligation goes from buying 200,000 shares of MSTR at 110 to having to buy 200,000 shares of MSTR at 90. So we go from a $22 million obligation to like an $18 million obligation. That's huge. That is huge for the portfolio. So again, you got to understand the risk that you have on, but also the moves you're going to make to combat it if things don't go your way. So now we've already agreed that the best case scenario is for Amazon to pump like 145, 150. If it goes up, it could spiral out of control. Like I'm having, it goes to like 200, it could spiral out of control. How do I know that? Because it's cool. Yeah, we'd make $1 million over here, but we're probably going to be getting annihilated on these short calls. So the best thing that I could do if it started pumping, at the very minimum, I mean, the first thing that I would do is I'd get rid of those 180s, eliminate those 1,000 contracts. Whether I make 20 grand or lose 20 or 30 grand is irrelevant. I want to make sure that I'm not losing $100,000 for every dollar that MSTR goes up if it were to do a moonshot. Because that's what you got to look at. Is like this 200,000 shares goes up $1. It's 200 grand. How many 200 grand do you have in your portfolio? So can y'all see the risks associated with that position? It's really, really important. Now let's go over to the capital requirement and be like, okay, well, how bad is it? How bad is it? How risky is it? Because remember, we saw that at 65%. We saw that at 65%. Point of no return. The expected price range is 60%. So it's right there. It's right there. So let's look at it. So let's like really, really look at it. So we're going to go risk analysis and let's see if it supports our theory. So it's in this area. It's in this area. Hopefully you guys can see the cursor there. I've made it. I mean, I feel like I don't know how much more obvious I can make this cursor so y'all can see what I'm looking at. So if it goes up, it stands to reason that these short calls are going to get clobbered and these short puts would make money. So let's go see if that's true. So if it goes up, sure enough, the short calls are losing a lot of money. But it would be offset by the short puts making money. Now, if I got rid of the 1,000 contracts at 180, we can forget about that price line right there. And we can see that the 627 is about $120,000 less than the 756,000 that we would be losing. So we're pretty delta neutral is what I'm saying there. Right now, it's a little bit skewed, but this is a shorter term trade. It's going to go away. It's going to go away. So I'm like, okay, what would it look like a couple of weeks from now? See what changes there. And can y'all see how that gets better for us? The risk to the upside goes away substantially if we fast forward the clock a couple of weeks, because these a lot of the theta would have come off the books on the short calls and the short puts. So if it goes up, you're seeing the price range right here from 1 to 139, 143, 147, 151, 155. We're not losing as much as we were before on the short calls because we were able to collect theta along the way. And then the puts would be printing money. It stands to reason, right? If it goes up, it's further away from the 110s. It stands to reason that the 110 puts are going to make money. Now let's go look at the downside. This is why ultimately this is a bullish position, because we make a lot less money if it goes up versus the amount of money that we lose if it goes down. So now let's look at, okay, it tanks towards our strike price of 110. This is putting it at 114.98. That's 15% of where it's at now. We're going to be losing money on the short puts. Here's the short puts right here, losing $1.1 million. And that's going to be offset by the monies that we're making on the short calls. This is, again, fast forwarding it to 410. Let's look at it for what it is now. So this is for what it is right now. So if it were to tank those short calls, we're gonna grab most of the money that's on those contracts. But then we got our ass kicked $1.1 million on the short puts. That's the issue, right? Because now we got to go back over here and we got to go look at what are the deltas. The delta's 20. So we're getting our ass kicked big time. If MSTR goes down, we're effectively losing $40,000. $40,000 for every dollar that MSTR goes down on these puts. And that's being offset by $27,000 for every dollar that MSTR goes down. MSTR goes up, these puts are making us about $40,000 for every dollar that MSTR goes up, and it's being offset by the $27,000 that we're losing on the short calls. So that risk analysis tool is just kind of telling you like how bad it could really get. So you don't have to play that what if scenario anymore. You can look at what is, but you can ultimately, once you learn how to read this right here, you'll know it just by looking at it, because you see the deltas. You have it all right here. You have it all right here. Let me check in with you guys, see if this is making sense, because I don't want to just be talking for my benefit. I want to make sure that you guys are getting some of it. Where are we at? Trump promised America first. Fair enough. G Money, he is going Israel first. Fair enough. First, unless you pay to get in the VIP line. I don't know what that means. Hey, TJ, thank you for this live ring. You're welcome. Gary, do you do any put credit spreads? If so, what would you recommend? That is just not a big part of my game right now. It's definitely something that I'm going to be eyeballing as I bring on another 3 tickers. I'm not going to start with just short puts. I'm going to initiate those positions with put credit spreads, or I will do short puts on PayPal, but I'm going to do put credit spreads on Apple and Google. Those are the ones that I'm eyeballing next. I got unfinished business with those tickers, and then Nvidia would be the other one, and end phase, and that would put us at 10. That's ultimately that's probably the max that I can handle just looking at because it's just like this is too much. It's just too much. Dad thoughts 555. TJ, do you have a general rule for a walkaway ROI? I found it allows you to walk away at 40%. For sure. For sure. The first 50% is a lot easier to capture than the second 50%. And we'll talk about why that is. It's your tail risk. It's your Vega. So the closer that you get to expiration, any price movement is amplified. It's a lot more sensitive. So if you've got 45 days on the clock, you have 45 days to expiration, the underlying goes up or down $2 or $3, nothing really changes because there's a lot of time left on the clock. But if there's 15 days on the clock and the underlying moves $1 or $2, your gamma is going to be a lot higher when you're inside of that 21-day window. The gamma accelerates your delta, which creates the more sensitive nature of the option to the underlying. So Tasty Trade's methodology is like, why mess with all that? Just go get the easier money and keep rolling and rolling and rolling, managing 21 days to expiration, and just go live over there on that first 50%. Because if you capture that first 50% twice, isn't that the equivalent of getting a very difficult 100% and thus eliminating or mitigating against the tail risk, which is your gamma? Your gamma is your tail risk, right? It's going to be the accelerator to your delta. Something to consider. So I think that you're onto something there, Dad. Thoughts? In a long direction options position, typically the result of rolling for shorter term, rolling in short term to defend it, or is it better to intentionally buy 100 and plus DTs from the start? Trying to understand the question. In a long duration option position, typically the result of rolling a shorter term 35 to 50 DT to defend it, or is it better to intentionally buy 100 of DT from the start? I'm not sure buying 100 DT from the start. What's ideal textbook is to sell 30 to 45 days out and managing 21 days to expiration. That all of the studies have proven that that is optimal. Appreciate the 467 people that have tuned in, the 70 people that are watching on YouTube. Guys, you want to save this one. You want to run your scenarios with your positions and be like, okay, are we a little bit supersized here? So the one thing that I did want to do here, though, is I don't think I'm getting paid sufficient for this risk. I know it's easy money. I know it's easy money. And it feels like, oh, shit, I shouldn't have to give any of this money back. But if MSTR were to go on a burner, it's going to cause a lot of pain to the upside. And just getting an extra $60,000 for the amount of stress that that would cause is just not worth it to me. It's just not worth it to me. So I am going to do the responsible thing, and I'm going to give, hold on, what are we doing here? I'm going to give that money back. I'm like, cool, made 22 grand. I'm thankful for it. I feel like I can make another 20, 30,000. But I'm like, is that worth it if they announce a deal? Like all of a sudden, whoever these people that Trump's talking to, they're like, oh yeah, everything's good. And this shit goes up to the upside. I've already shown that I can manage these short puts. These aren't really causing me that much stress. We're losing money on paper, but they're not causing a lot of stress. I could roll this thing out a few months and go to 100, go to 90, And now we're getting closer to levels to where I could actually afford and would want to take ownership of those shares. But on the upside, not liking it. So I want to lock in a real small win there. It's nothing crazy. It's something though. How much did we get paid? 82 cents. Okay. So I'm going to try to close this out just I'm going to give them $1 more just to be done with it. There we go. There we go. Now I've just eliminated a lot of the risk to the upside. So we got even more directional here. We benefit a lot more if MSTR goes up versus it going down. Why? Because we've got $304,000 in extrinsic value tied to the short calls versus $1 million in extrinsic value tied to the short puts. So I don't know if this is going to update that quickly, but we can check it out. We can go over here and we can look at it and see if it is already zeroed it out, right? So we're going to go here. Let's see if it already zeroed it out. And it has. It's already zeroed it out. So now let's look at it. MSTR does a moonshot. You can see that it doesn't hurt us as bad, right? We only lose 117,000. Why? Because the money that we're making, that we're losing on the short calls is being offset by the money that we're making on the short puts, because we started with a much higher extrinsic value on the short puts versus the short calls. But now we are going to get clobbered on the downside, but we're still making the 303,000 on the short calls. And we're losing the 1.1 on the short puts, but that was only another $60,000 that we would have made over here. And that just wasn't worth it for the amount of risk that we had to the upside. So that little move right there has made it to where MSTR is just going to cause a lot less stress for me. A lot less stress. I feel like MSTR, like we're solid. Like we are solid now. We don't have to do anything. We just have to wait, and we're collecting data. How much? $35,000 a day. So I'm like, I can stay in this trade for 2 weeks and make, $500,000 probably, if Bitcoin just camping out between like 65,000 and 75,000, which I feel is a very high probability that would happen. So now I'm cheering for, obviously we have a 20 delta versus a 10 delta. So I'm cheering for MSTR to go up to like 140. Camp out there. We get closer to expiration. I'd like for it to get to 145 even. 150. Because that would be like equidistant, right? I think 155 is equidistant. That would be ideal. That would be super, super ideal. Now, if she tanks more, what could I do instead of rolling out? If I don't want to roll out, she tanks, but I don't think she's going to 110. I don't have to roll out. I could roll these calls down, and I can lock in that win right there, right? I could roll this call down to say 180, which is still outside of the expected move, just outside of the one standard deviation. And I could pick up another $294,000 and increase my buying power because I just got more delta neutral, because we go to what, 20 delta versus 17 delta. I like that move. So I gave back 60. Pick up 293,000 with fees, and it increases our buying power by 179,000, which is going to be like 1.5 percentage points on the buying power reduction, on the buying power usage. So that is a better move than having those extra 1,000 contracts, if that makes sense. Because that's another thing that I've learned. It's not, you don't just necessarily have to add more contracts. You could just adjust the goalposts. to monitor your risk. So I'm like, I want to eliminate some of that, not eliminate, but reduce some of that risk to the downside. Just get more aggressive on the upside. If you feel like there's a lot of pressure on Bitcoin, there's a lot of pressure on MSTR, but you want to be able to stay in that fire a little bit longer because you're like, okay, I think you can get to 120. Hell, it might get to 115, but even if it touches 110, I don't think it's going to stay there because you're playing to your investment thesis. You want to stay in it longer. If you're willing to take on more risk on the other side, it's going to reduce the risk to the downside because those deltas, that extrinsic value is going to offset. Plus, I would be locking in a real nice win of $286,000. And what's the goal? We're trying to get back to even on this trade. So now we're going to look over here. You're going to see the total P&L there. We just made $21,000 on those short calls, right? Being in the trade for a couple of days. Not bad. Not bad. Who's not excited about making $22,000 in a couple of days? But we're still down $1 million. We're still down $1 million collectively. And this is my break-even trade on MSTR. And we have what? 1.36 million in extrinsic value, all expiring or coming to a head in 50 days. So I'm like, if I get more aggressive on the short puts, if I get more aggressive on the short calls, I'm sorry, I don't have to roll out to the next cycle just yet. I could try to go get some more premiums on the short calls, and then I could exit this position at like 30-40%, and we can capture $500,000-$700,000 of the money that's on the table, and then we can roll out. And then on the next cycle, maybe we get to break even. Maybe it just wasn't meant to be to get to break even on this trade. But we are working our way towards breaking even altogether. I hope y'all are getting value out of this today. I hope y'all are getting value out of this today. Again, I'm not doing this for me, man. I'm doing this for you. I know how to do this shit. I have figured out the metrics. We're ready to print money here at TJ the Wheel Deal LLC. We are ready to print money. I paid my tuition for the next year. Now everybody's going to be up on my nuts when they see this thing growing at $500,000, $1 million a month after month after month. Because once I figure out the metrics, once I know that it's sunny and 75 and the sun's out and it's ready to make hay, I'm the guy that knows how to bale a bunch of hay. That's what I do. I have figured out the metrics. I'm trying to show y'all what those metrics are so you can figure them out for yourself. Anyway, type in helpful. This is helpful for you guys. I'm going to check in with a couple of more y'all here, and then we are going to be done for the day. I appreciate each and every one of you guys. Dad thought might make more sense. So puts the DCA and so cover calls on a bright green J if your timeline is June, but if holding to the long-term 20 is a solid average, in my opinion. Peace. I think they're talking about, was it SoFi? Yeah, that makes sense. Where did I see SoFi in June? Shit, man. Hopefully about 2021 would be ideal. Just saw you at the mid and only joined midway through, but you sound smart and successful. Well, I appreciate you. Appreciate you, Callum. How are you managing your SoFi? Let's talk about SoFi. I haven't looked at it. I haven't gone through the whole portfolio yet. Jesus. Okay, let's see. What's going on with SoFi? There's not a whole lot to do right now. So that's not the right metric. It's this one. Okay. SoFi. What's going on with SoFi? Let's talk about Palantir first. Let's just go in order. Oh my God. What if Palantir goes here? Oh my God. What if Palantir goes there? Well, let's see. Let's see what it says. Let's see what it says. Because I'm looking at a 20 delta versus a 10 delta. I'm sorry, wrong line. Palantir. I'm looking at an 18 delta versus a 10 delta. So we're not necessarily delta neutral, but we have 5,000 contracts on the puts versus 2,000 contracts on the calls. I'll get to SoFi. Let me just stay in order. So I already know that if Palantir goes up, these guys are going to start losing money, but these guys would print. If Palantir goes down, these guys are going to lose more money. And these guys are going to print, which is what's happening today. So now I got to ask myself, do I want to lock in a win on Palantir on these calls and just be done with it? And then maybe play something shorter dated? pick up $300,000 and because I give all this premium back, be done with it. That would hurt the buying power, by the way. Like if I did that, that would hurt the buying power. So these are things that you should learn. Why is it going to hurt the buying power? Because you're 100% directional on Palantir. You need Palantir to go up to print money. Because if it goes up, this prints money. This one loses money. So you don't have your hedges on, if you will. You're taking one of the hedges off. You're removing one of the goalposts. So whenever you remove the goalpost, you become totally directional. So let's just see the implications on the buying power if I were to try to lock in that win. You see how that hurts the buying power? So these are things that you need to start learning whenever you're doing this. Like you're like, okay, if I do that, it's going to hurt the buying power, help the buying power. So how could I not hurt the buying power so much, but I want to lock in some of that win? What could I do? I could potentially look to roll this position to try to lock some of that money, lower that, roll the expiration date, but I'm not going to roll it. I want to actually try to roll it in, delete the legs. So I'll be like, okay, we're like way over here. So let's see if we can do something in June. But I want to stay over here. I want to stay over here at 220. So that's a debit. Or did I do it? Or here we go. So you give some of the monies back, but you take premium off the table, or you take time off the clock, and it doesn't reduce your buying power as much. That's one option. Don't really like that option. Don't really like that option. What about just rolling down and keeping the same expiration date so I could try to lock in that win? That's going to hurt the buying power some, but I'm going to capture more premium. So that might be worth it to us. We're at 58% buying power. So let's see, what about rolling to still outside of the expected move, but going from 200 to 210 or for 220 to 200? You see, it hurts the buying power. So we were already right there. The logic was right, but we're going to collect more premiums, which gives us what? More protection to the downside. Why? Because the position becomes more delta neutral. That's something that I'm going to consider when I get to 50%. It's something that I'm going to consider when I get to 50%. And then I go look over here and what's Palantir done? Just made us a shitload of money. If I close this out, we lock in that 695,000. But then I'm going to create, in my mind, what I feel is like a bit of a whipsaw effect. Palantir shoots back up to 155, 160. Cool. I locked that in. Looks good for the P&L. But then now I'm starting to get my ass kicked on the short calls. So I'm like, you know what? I don't want to do it. I don't need to do it. And I had another one. I had 500 more puts or 500 more calls. And I did the same thing as MSTR. I took the trade off. I don't know that it shows it here yet. It might be under activity. Here we go. I had the 180 calls. Paid 86 cents a day ago. I closed them today for 55 cents. So I locked in a nice little win there too. I was like, I'm not getting paid enough for that risk to the upside, even though I don't think Palantir is going to 180 in 22 days. I just didn't like the way that the graph looked. And now let's go over here to the capital requirements tab. And we're going to click on Palantir and see what she says. So it's in this area here. She goes up. It stands to reason that the short puts are going to make money. But it's also going to be offset by the monies that we're losing on the short calls. So again, it's like, what happens if Palantir goes this way? Because he's trying to play to his audience, because those are the questions that he gets asked on a daily basis, right? So, okay, so what happens if it goes up a lot? It goes to, you wake up and it's 172. What happens? You don't have to guess. It tells you. You make 974,000 on the short puts, and you're losing 1.27 on the short calls for a net loss of 296,000. but you're losing a lot more if Palantir goes down. So this is a net bullish position on Palantir. So Palantir goes down, you're losing 1.37 million on the short puts, and you're making 753,000 on the short calls. So how is that? It comes down to the extrinsic value, because the short calls only have 864,000 in extrinsic value versus 3.575. If I rolled these out to 200, if I rolled these down to 200, roll these strikes to 200, now they're going to have another $500,000 of extrinsic value. So if we go down, if Palantir goes down, we're not losing as much money because there's a lot more meat on the bone on the short calls as opposed to now. But I'm still, it's a move that I'm contemplating making. Not yet. Let's go to SoFi. What's going on with SoFi? We got 25,000 shares, guys. So this should sound like a broken record already. If SoFi goes up, it stands to reason that the shares are going to print and the short puts are going to print. The short calls / cover calls are going to suffer. If SoFi goes down, it stands to reason that the shares are going to suffer. They're going to go down in value. They're going to depreciate. Your short calls are going to print. Your cover calls are going to print if SoFi goes down, and your short puts are going to suffer. So what do we have going on here? We have an agreement to sell 500,000 shares of SoFi at $25, 148 days from now. We're up $70,000, and y'all know that I was at 30 and I rolled down, right? Y'all remember that? I rolled down from 30 to 25. We locked in $190,000 on those naked calls / covered calls, up $2.3 million. Everybody wants to talk about, oh my God, you lost a lot of money on PayPal. Nobody wants to talk about the millions that we made on Palantir and SoFi, because that's just the way people are, right? That's just the way people are. I'm just figuring out which menu items are making the money. That's what I'm doing. That is what I'm doing in a nutshell. SoFi and Palantir make money. I think that Amazon is on the verge of making money. MSTR is going to make money, and I feel like we're at least making money on the short calls on BM&R. So now we've got menu items that are ready to make money. That's why I'm saying we're ready to print. We're ready to print. So what are we doing on SoFi? We're about even on the shares, so it's kind of a nothing burger there. And the calls are making money. So now what we want to go do is go look at our risk analysis and see, well, how much money do we make to the upside versus the money that we lose to the downside? Because we want it to go up, but we don't want it to go up too much, because at some point, the money that we're making on the shares and the puts is going to be offset by the money that we're losing on the short calls. So you just got to understand the analytics before you just go look at a bunch of numbers, because you might get overwhelmed. So now we're going to go to the cap requirement, and we're going to go over here, and we're going to go find what? We're going to go find SoFi, and we're going to click on it, and we're going to go risk analysis and see if it supports our theory. It's bullish if she goes up, right? It's bullish. This is again plus minus 15%. So it's right in here. If she goes up, we ultimately make $15,000. How? We're making the money on the shares. We're making money on the short puts, and that's being offset by the money that we're losing on the short calls. So when people are like, oh my God, you're being so irresponsible, look at all of those naked calls. I'm like, dude, you need to learn how to do math. You need to learn how to do math. You don't need to cover the entire position, because you're also making money on the short puts if it goes up. Learn how to do some math. You got to understand the Greeks, man. You got to understand the impact of the Greeks on your position. So this thing's already showing you, this thing spikes up 50%, 15%. You're good. You're good. It goes down, it hurts you. Why is it going to hurt you? Because you have all of these short puts at 15 that would now be in the money, right? It's at 1360. So it stands to reason that you're going to get your ass kicked on the short puts. It's going to be offset somewhat by the money that you're making on the short calls. But then don't forget that you own the 25,000 shares. So you're going to get annihilated on those as well. And that's why the loss is a lot bigger to the downside than it is to the upside, because we're essentially net bullish on SoFi. Make sense? Again, this is for you guys. I know how to do this shit. Does it make sense to you? Because if it doesn't make sense to you, then we're wasting each other's time. I could go bug my wife. I might get lucky. Who knows, right? So, anyway, we're having a little fun here today. Let's get into it. Thoughts on Oracle for covered calls? I haven't looked into it, man. I can't speak on that one, to be honest with you. I've got my hands full with the positions that we got going right now. Where are we at here? Buying more SoFi leaps today. Help. Catching some goes over my head, but I'll keep studying little by little. I'll get there. Right on. So we talked about SoFi. So I'm not really doing a whole lot with SoFi right now. I've already rolled down from 30 to 25. I'm not comfortable lowering any more than that. I like 22. I just feel like at some point I'm going to end up giving all that premium back, because I think SoFi is going to go on a run, especially when they put out another earnings report, yet another double, possibly triple beat. And then the market's going to forget all about the short report. They'll be like, oh my God, like, why did we ever doubt you, Anthony Noto? Oh my God, sign my baseball card, that kind of thing. Sign my football card. Yeah, so I don't want to. I'm thankful for the money that I've made on the naked calls and cover calls on SoFi, but I don't want to press my luck, if you will. I don't want to press my luck. Can I ask, what about your focus on with this channel? Is it portfolio reviews, market recaps, daily streams, or possible plays? I think your channel would do well with an intro video to help newbies. The purpose of this channel is for you guys to watch me take this account to 100 million bucks. So we'll learn all of it along the way. It's like, I want y'all to follow the journey while you're on your journey as well. I want to help other people, do well. And a lot of y'all copy my trades. I know that. So I try to go live early and often to make sure that if I made moves on the portfolio, if you're just copying, which I don't recommend, but if you're doing that, I know a lot of y'all do, because I do FaceTimes with a lot of the members. Y'all are just like copying, and that scares me, because if you're not learning, at some point you got to learn how to fish. Yesterday, I often take out the hedge when I made some money. I guess I should be thinking about rolling instead of closing. I'm watching, I'm learning. Right on. What's going on, my man? Thoughts on Oracle? Anybody here from UK doing this? Adding Microsoft shares, selling IRA and cash secured puts, and watching my hood covered calls expire worthless feels like a Friday. Let's go. What do you think about the price action on PayPal middle term? I think PayPal is going to get back to 50 here pretty soon. I'd say within the next 90 days, it's going to get back to 50. It's going to formulate a base there. I think this dude goes and cuts the workforce. PayPal will go make a home at 55 to 60. SPX credit spreads have been cooking for my right on. Best advice for student model portfolio, no margin accounts, and only permitted either buy and call, buy put, no put and call holding at the same time for security. Best advice for students with small portfolios, i.e. less than $500, no margin accounts, and only permitted either buy, call, buy put, no put and call holding at the same time for security. Yeah, $500, it's tough, man. What can you do with $500? I think the first thing that we got to also address is, what's your funding strategy? Like, do you have a side hustle going? Because the fastest way to grow a small account is to just do something in your life to make more money to deposit into the account. You can do like a leap. You could buy a leap. You could buy leaps on something that you're really, really bullish on, so you can try to get like a supersized return. You can maybe sprinkle in the poor man covered call if it'll allow you to do that. I don't know if $500 is enough for that. I think that you need like 2,000 or 2,500. I'm not sure what the requirements are. It's been a long time since I had that little money, so forgive me. But you could own shares. Shares don't expire, and try to get a 2x, 3x on the shares. That's one way to grow the account as well. I'm not sure. I think they allow you to buy calls and buy puts when you have little money. I don't know if they let you sell calls or puts. And keep in mind, you got to be able to do 100 shares. So it'd be less than a $5 stock. Uh, I want to own shares of SoFi. Is it okay to buy shares and sell calls while it goes sideways? Yes, but you also might want to consider a Daryl profile pic looks sharp, man, with suit and everything. You might want to consider using those premiums to buy some leaps, some protective leaps to the upside. That way, if SoFi does go on a burner, you're not another tragic covered call story on X where it's like, oh my God, I sold my shares at 18 and it was like against the law for me to buy the shares back. And so if I went to 100, I'll never do that again. And you blame on the cover call strategy. When it's a jockey problem, right? It's a strategist problem. It's not the strategy. It's a strategist problem. Anytime I lose money, it wasn't because of the strategy, it's because I just didn't manage it accordingly. I didn't manage it accordingly. My entry point was off. I was playing too big with low IV because that has kicked my ass a couple of times. 6 figures. Playing too big with low IV. You're going to play real big, guys. Make sure that the IV's high so that you're also playing not just for price movement that's beneficial to your positions, but you're playing for that IV contraction because that's the easiest way to make money as a premium seller is just play for the IV contraction. So yeah, I think that's cool, but just be mindful that at some point especially if she consolidates for a while, it makes the move either up or down pretty violent because like forms like a wedge, if you will. Uh, so maybe you might want to like use those premiums to buy some leaps. That way, if those cover calls get out of hand and you don't feel like rolling and babysitting, you just let the shares get called away and you can at least write up the leaps. How would you handle cash put on Meta at 570 expiring on 417? What's it trading at? What's Meta trading at? 570. Let me find Meta. Meta. Where are you at? Meta. Well, like, so Donald Trump did a news conference talking about like how the war is like pretty much under control, but it seems like the market's not believing him. Okay, so Meta's at 5. Wow, that's crazy. That's crazy. Is it the lawsuits? Is it losing $90 billion on the metaverse? Like what? Why does the market not like Meta right now? Oh, the verdict, the legal verdicts. Yeah, Meta, man. There's kids, there's people with mental health issues. They go on these social media platforms and it's tough. And you can't just blame Meta. You got to blame the parents. You got to blame, there's a lot of stuff to put the blame on. But, okay. And you're at 5. Where are we at here? At 417, which is what, a month from now, give or take. I'd probably roll. I'd probably add another month to the contract and go to like 560, 550. Not financial advice. That's just what I would do because the sentiment looks really shitty. Whenever I look to take ownership of shares via cash put assignment, which happens very, very rarely for me, very seldom, you want to at least get on the other side of the sentiment. It's okay to be underwater on the shares, but don't be underwater on the shares and the sentiment, right? Like look for that trend reversal. And it doesn't have to be on the chart. It could be a trend reversal on the sentiment. And because it might show up on the sentiment first and then it'll show up on your chart later, right? So that's what I would look to do. Agreed. Think for the idea is true. Lawsuit news. Yeah, there we go. All right, guys, man. I hope y'all have enjoyed it. I feel like we went to school today. I'm learning more and more metrics. I'll reiterate some of them that I learned here just to recap. Uh, the rule of 0.5% and 0.75%. So you take the net liquidation value and you multiply it times 0.5%, 0.75%. That's probably the absolute max that you should try to have on your theta per day at any time. Because if not, it's just getting too big. I wanted to do 1% and it just doesn't work. And I know for a fact because I've already lost 7 figures 3 times over trying to play at that 1%. You just run out of buying power. You just do. So don't do that. There's another rule of 500. There's another rule of 500. I haven't found this metric anywhere else, but my buddy who has over $100 million in the market and all he does is sell strangles. So you take all of your contracts and you multiply it by 500. And that should not exceed your net lick. And I'm like right there. I'm like right there. That's why I took off those 1,000 contracts from MSTR and the 500 contracts on Palantir. So you take all of the contracts that you have, you multiply that times 500, and that should not exceed your net lick. If it does, you're playing too big. I don't know where he got that rule. Maybe y'all can help me find it. He said that a Charles Schwab guy talked about it. I looked for it on YouTube. I could not find it. But he's been in this game for about 25 years. And he's like, all that other shit is just shit. I'm telling you, the rule of 500 is where it's at, kid. I was like, all right. So I'm going to go on a mission, on a fact finding mission to figure out his rule of 500. And I'll keep grilling him as we talk a little bit more. You're awesome, generous with your time and knowledge. Appreciate you. All right, guys, I got to run. I appreciate each and every one of you guys. TJ the Wheel Deal signing off. As always, from your Sky Stay Blue Stock Screen. Peace out. God bless you guys.